Good day everyone. Today, we're diving into a fundamental concept in financial management, the weighted average cost of capital, commonly referred to as WACC. This lecture will cover the definition of WACC, its historical background, and the key components involved in its calculation, including the cost of equity and the cost of debt. We'll also explore relevant theories that have shaped our understanding of WACC. The weighted average cost of capital, WACC, represents the average rate of return a company is expected to pay to its investors, including both equity shareholders and debt holders. It reflects the average cost of each component of capital, weighted according to its proportion in the company's capital structure. The traditional view of WACC focuses on the idea that a company's cost of capital is influenced by its capital structure. Traditionally, it was believed that a company's cost of equity increases as it takes on more debt due to higher financial risk. This view emphasized balancing the benefits of debt financing with the increased cost of equity as risk rises. The Modigliani-Miller theorem, proposed by Franco Modigliani and Merton Miller in 1958, revolutionized thinking about WACC and capital structure. Their theory, under the assumption of perfect markets, posited that the value of a firm is unaffected by its capital structure. According to WACC remains constant regardless of the proportion of debt and equity, because any benefit from cheaper debt financing is offset by the increased cost of equity due to higher risk. Later developments expanded on MM's work. The introduction of taxes in the real world led to the Modigliani-Miller proposition 2 with taxes, which asserts that the value of a leveraged firm is higher than that of an unleveraged firm due to the tax shield on debt. This tax shield effectively lowers WACC as debt financing becomes more attractive. The cost of equity represents the return required by equity investors given the risk of the investment. It is the compensation investors expect for taking on the risk of owning shares in the company. Next, it is necessary to compare the individual company and the market indices from which the historic returns were computed. It is equally clear from one day's observation of the stock market that not all shares move in the same direction at the same time and to the same degree. As is well known, diversification reduces risk. This begs the question as to what the performance volatility of an individual share is compared to the market average. One of the most widely used methods to estimate the cost of equity is the Capital Asset Pricing Model, CAPM. The CAPM is only valid within a special set of assumptions. Although these, and other, assumptions are rarely met, CAPM is one of the most frequently used models of risk and return. The CAPM divides the volatility of a stock's price into two parts, the specific risk and the systematic risk. In theory, the specific risk can be diversified away on a large well-spread portfolio, leaving the systematic risk, which is the volatility of the individual share compared to the market as a whole, which cannot be eliminated by diversification. Here are some examples of systematic risk: business or trade cycle, interest rates, inflation, tax, currency, and freak events. This list is not exhaustive, but it does show that there are strong grounds for saying that there will be risk in equity prices that is systematic and not specific to individual companies. Beta is a measure of a stock's volatility relative to the market. A beta greater than 1 indicates higher volatility than the market, implying higher risk and, therefore, a higher cost of equity. Conversely, a beta less than 1 indicates lower volatility and a lower cost of equity. By using CAPM, the cost of equity formula is as follows. The beta of a company's shares, and hence the cost of equity, is affected by the company's existing gearing. If the gearing were to change, then the volatility of returns would change, and hence the beta would change. If the gearing changes, the new beta must be found in two stages. Find the ungeared beta first. Then find the new beta for the new level of gearing. Another method of measuring beta is by looking at the company's historical return. Alternatively, we can estimate beta by regressing the share's returns against returns on the market index. The regression fits the best estimate of beta in the model. However, note that estimates of a company's beta, derived from regressing the company's stock price performance on that of the market, will vary with the period over which the estimation is made. One way of improving the estimate is to use an industry beta based on a group of similar companies. By similar, we mean more than that they are all engaged in similar activities, as the nature of their activities will only affect the business risk of the company or industry. Geographic areas of operation will be important, but we also need to ensure that they face similar financial risk, that is, that they have similar capital structures. Crude values of beta derived from historic observations will be influenced by financial leverage, or gearing, and this needs to be allowed for in our calculations. Next, we will be looking at cost of debt. In deciding the relevant cost, one needs to assess whether it is the marginal cost or the average cost that matters. Marginal cost adds new complexity. If new debt is being raised to help finance a project, then it would be reasonable to use the marginal cost. The cost of debt will vary from company to company depending on its creditworthiness, often expressed as a credit rating. The cost of debt will be related to the credit rating. The lower the credit rating, the more the company will have to pay for debt. The followings are the determinants of cost of debts: interest and asset cover. Gearing. The marginal cost of debt will increase as the level of debt is pushed up because of the adverse effect on the company's credit rating. Beta. The beta can therefore have a direct effect on the credit rating, since a high beta will indicate more volatile profits. And lastly, tax. The cost of debt capital can usually be offset against profits and serves to reduce the effective cost of debt. A new company may not yet be in the position of making profits and so is at a disadvantage. In assessing the cost of debt, it is necessary to make an assumption as to when profits will arise. A reduced rate of tax deduction to reflect the deferment may be used. Finally, we can calculate the weighted average cost of capital, WACC, by looking at the mix of debt and equity actually employed, and so will result in a value below the cost of equity.